You're listening to Storage Nerds Podcast, where we unravel the best-kept secret of the real estate investing world, the storage industry. Join the grassroots guru in self-storage, Stacy Rossetti, in insightful discussions about finding, funding, and running these spaces, allowing you to yield the highest returns possible. Get your foot in the door on self-storage and discover how to properly purchase facilities, negotiate with sellers, and close the deal without worries. Start unpacking that investment wisdom with Stacy right now.
I'm here. Sorry, running a few minutes late. How is everybody doing? Say hi to me in the chat. Introduce yourself if you're new. And tell me where you're located. Tell me why you're interested in storage. I'm teaching today. I'm going to teach. All right. Last week we had Valerie come on. She's one of my students. She came on and talked about buying one of her storage facilities. And the week before that, I think we had Matt come on, and he talked about one of his storage facilities that he bought, or a couple of them actually he's bought. And then actually, I think my husband came on and he taught like a couple of weeks ago as well too. He taught about managing self-storage and like a whole bunch of like about boots on the ground and hiring your boots on the ground and managing your boots on the ground. So those were all kind of the last weeks I've been like delegating this webinar here, this podcast to other people. But today I figured I would teach. I haven't taught in so long, So I just wanted to say, thank you for coming, hanging out today. I'm Stacy Rossetti, and, I teach people how to invest in self-storage. I also get my camera straight. I also invest in self-storage together with my husband, and we own 11 storage facilities. For all of you that don't know us, in the Georgia, Florida area, we have one under contract right now. We have two under, actually, that's not true. We have two under contract right now. And so we're looking for money for those, and that's kind of the goal now. Once you get into commercial investing, you really just kind of realize that it's all about raising money. It's management and raising money. Everybody's always asking, how do you find them? How do you find these things? But the truth is you got to learn how to raise money, because commercial real estate investing is expensive. It is, right? Unless you want to stay in the little tiny facilities. And there's nothing wrong with that as well too, and a lot of our facilities are smaller. We started out with some smaller facilities, but we own to the big boys now, right? So we're moving on up. Actually, not that big, but we're like $1 million, $2 million properties now. And it's not super big, but they're big for us, right? And so kind of that's where we're at. So you can keep following us. I am I'm here every single Monday night. I keep forgetting to say that, but I'm here every Monday night. I teach every Monday night to anybody that wants to listen to me. And then right after this, I pitch my fund, which is called the Self-Storage Fund of America. So for all of you that are listening now, if you want to just do passive investing, right? If you're like, I don't really want to do all the work. A lot of people think they want to do the work, and then they start getting into it, and then they realize they don't want to do the work. Because it is work to get out there, talk to owners, look for facilities, learn how to run deal analysis, figure out if it's a good deal and stuff. I mean, that's a good first step. And a lot of people get into it and then they realize they don't want to do all the work. If you don't want to do all the work, then what you should do is you should invest in a fund, right? Or you should partner with somebody and have them do all the work. And so we have a fund. It's called the Self-Storage Fund of America, for anybody that's interested in getting started in self-storage, but just don't really want to, own, or they don't want to actually take the time to learn how to do all this. Passive investing is the way. I'm telling you, over the next couple of years, passive investing is going to be one of the best ways to make money. in real estate investing. And when I say passive investing, I'm not talking about owning it and having like passive income. I'm talking about like true passive investing. True passive investing is when you hand your money off to somebody else and you let them work your money for you. And the truth is over the last 10 years that I've been doing this, I have made my investors millions and millions of dollars. And so we are asset managers. We have become asset managers. And then a lot of people kind of rely on us to make money for them. And which is the role that actually we're meant to be in. I mean, this is what me and my husband do best. And we're going to, we're just continually growing that. So today, I wanted to talk about a couple of deals that my students brought to me. If you don't know, I own Storage Nerds. Storage Nerds is a coaching program where we teach people how to invest in self-storage. My husband helps, and then I teach, and we coach. We hold your hand, we guide you, kind of like show you what you should do. And we opened the doors in May, which is really exciting. We had a whole bunch of people come in, and then we closed the door. So we only opened the doors for 2 weeks. And so now all those students are out like calling and talking to owners and like, looking for facilities to purchase. And the good thing is that there's a lot of people in the group, a lot of students that are finding deals. And 2 of them actually we went over today in my coaching calls. So I do one-on-one coaching calls every Monday with all my students, and I get to like hear what they're doing. It's like one of my favorite times. I can like hear what everybody's doing, hold them accountable. And so we had 2 different students bring a couple of deals to the table. One of them is a female. I don't know if she's on here. I don't think she's on here. She's working. She's not on here. But she does not have a lot of money at all. She's coming up with money for the coaching program. And then her idea is that she wants to wholesale a couple of deals. And then after she wholesales a couple of deals, then she should have some money to go out and find her own property. So that's kind of what she's working on. When you are a wholesaler, essentially what you're doing is you're calling and talking to owners, and you're the one that's doing all the work, really. You're the one that's trying to get the owner, all the information from the owner and running the deal analysis. So she just essentially like, in the last 2 weeks, she started calling owners, and she lives in the Texas area, and she started calling owners, and she found like a good handful of them that wanted to sell. And, and that's really, people just don't realize that if you just call and talk to owners, you'll find some that want to sell. It's a numbers game, obviously. If you're calling in primary markets and maybe even secondary markets, it might be a little bit different than in tertiary markets. But anyway, she called and she started talking to these owners. And so she does have a deal that she brought me, and we ran deal analysis on it. So I was going to kind of show you that one. And then also we have another student that brought me a deal, and he basically got it from a wholesaler. And so basically he brought me the deal, and he was like, is this a good deal? I mean, that's what he's asking. He's like, is this a good deal? So we ran the numbers and kind of went through the whole process of how we figure out if it's a good deal. So today I thought what we would do is we would just ask the question, how do I know if it's a good deal? And then I'll help you to answer that and go through with that. Okay, so let's get started. And I'm going to go over what one of the students brought to me. The first one is, let me find it. Yeah. And let me share my screen. How do I get to Zoom and then share my screen? You would think that I know this by now, but no. This is what he brought me. It's a smaller facility. We don't have the location, so I'm not going to go over where it was. But what I want to just show you is kind of like, this is what the wholesaler gave him. Now, do I like this? Not really, but okay. I mean, it's a good start. As a wholesaler, all my students know how to put together the most amazing, awesome wholesaling package in the world. But essentially, this wholesaler gave him, this is what he gave him. Okay, so as you can see here, There is 16 5x10s that they get $45 for. It's 700, and they make $720 a month off of that. 23 units that are 10x10 at $60, they make $13.80 a month, and 9 units that are 10x20s that are $90 each, and they make $810 a month. Okay. So the total revenue is about $2,900, $2,910. The annual is $34,920. Okay. And then this is the list of the expenses that the owner has. Now, the list of expenses that the owner has is probably not going to be the expenses that you have. So everybody always says like knowing, what their expenses are is important. And it's, for the truth of the matter is really what you need to know is your expenses, not their expenses. Okay. And we'll get into that in just a minute, but they're spending $1,008 on the web, right? Which I'm guessing is probably the software that they're using. And I'm not sure if they, have a website or not, but I'm guessing that there's no website included into this price, right? This is probably just the back office like software is that they're using. And then the utilities is $1,320. So if you divide that by 2, I mean, essentially it's like, $100 a month. I mean, that's like typical price for utilities. If there's electric at a small facility, it's going to be about $100, $50 to $100 a month. Insurance is $924. And the marketing and insurance includes like, like if there's it's like a storm or something comes in and ruins it, or a fire or something like that, right? So hazard insurance, liability and hazard insurance is basically what it is. So this is not tenant insurance, right? This does not cover any of the tenant's belongings. It just covers what for the building is what it covers. Okay. It's a commercial insurance policy, liability insurance policy for your facilities. Marketing is about $1,000. So we're not sure what they do with marketing, but we know that they're doing some sort of marketing. And the merchant is $873. So that's like all their credit card processing and things like that. The domain is so this is the domain. So they do have a website. It's $360, right? So they have probably the back office software is here, and then the domain to hold the property is here. I'm sorry, to hold the property management side is here. Taxes is $1,233, right? And the on-site, maybe boots on the ground, maybe repairs and things like this is $2,000. When they say on-site, I would consider that to be boots on the ground. So their annual expenses come out to about $87.18. Okay, we'll get that here in just a minute. And then, as you can see, this is what they're saying that the competition could do, right? So 16 5x10s is $65, and they have $45, right? 23 10x10s is $85, and they're doing $60, and 9 10x20s is $125, and they're only doing $90 right now. So they should be making over $4,000, $4,120 a month, and they're really only making $29.10. So they should be making $49.40, so $49,440, so almost $50,000, minus their 7% vacancy, right? Very important to know what the vacancy is. So they've minused out the vacancy here, and then they've also minused out the expenses. So the NOI is $37,261. All right, so that's the NOI this is what the wholesaler gave the student. And his question is, so now we got this, great, awesome. Looking at all these numbers, how do we know if it's a good deal, right? Anybody else thinking this? How do you know if it's a good deal? Well, in order to know if it's a good deal, you have to be able to run commercial deal analysis, right? However that you run commercial deal analysis is up to you, right? I mean, what you need is some sort of like a deal analyzer. You need something that you can use to run commercial deal analysis. I'm going to use my spreadsheet because this is what I use internally, but you can go into the web and you can go search all different kinds of commercial deal analyzers. You can, buy them. You can get them from somewhere else if you want to as well too. All my students have access to our deal analyzer. So if you become a student, you have access to the one that I'm going to go over, but you can also find stuff online as well too. A really good company and a really good friend, his name is Joe James. He created a deal analyzer called ROI Muse. Maybe Ariel, and if you have time, if you can find that, you can put our link into the chat so everybody can have access to that. But ROI Muse is an online deal analyzer for commercial deal analyzer. And really it's just Joe's deal analyzer that he lets everybody use. And he does apartment buildings, but the truth is like commercial deal analysis is commercial deal analysis. Maybe it's a little bit different here and there. They say doors, we say square footage, but it's typically kind of the same stuff. Now, what we're going to do now is we're going to use my deal analyzer. We're going to run the numbers. Let's take a look at it. Let's see how this deal is. Okay. All right. So let me pull up my deal analyzer here. Okay. And let's see. I'm going to figure out how to share my screen again. Let's see here. So here's our deal analyzer. This is kind of what it looks like. I'm going to take the, I stopped screen share. Take the information that we got on this pro forma, and I'm going to put it into this deal analyzer. The way that our deal analyzer works is any place that's in yellow is an input. Right? And we've called that the info sheet. And this is where you'll input all the information so that it will spit out an analysis for you. Every single one of these tabs across the bottom of the deal analyzer is super duper duper important. All right. You can't just fill out this one, look at it and call it a deal or whatever. Right. So we'll go through these and I'll kind of show you what is there. And show you kind of how I know if it's a good deal or not. Okay. And what we do, what we use. So let me pull my sheet up again one more time. Okay. So we have, let's go in here and let's do this. So we have 16 plus 23 plus 9 is what? I have no idea. Who can tell me this? 16 plus 23 plus 9 is, my brain's not working either. So I have to pull up a calculator. 16 plus 23 plus 9 equals 48. Okay. So we have 48 units. All right. So this is kind of a small facility, right? But it's like, honestly, the truth is like most likely if you're listening to me, you're okay with buying a small facility because this is what I do. I buy small facilities, right? Okay. So let's do 48. And then now we need to figure out the total square footage. And then we have to figure out the annual income. All right. So annual income is, let's pull this sheet up again. 34,920 is what it is. 34,920. So let's do 34,920 here. Annual income. Square footage we'll figure out in just a minute. And then remember what the vacancy was. If anybody can remember, they said 7%. Okay. And then they gave us their expenses here. So the expenses were, let's see, property taxes, utilities, and insurance. Utilities is 1,320 and insurance was 924. So 1,320 and 924. Now, with property taxes, essentially the way it works for me is I pretty much just double what they tell me because the truth is that they're probably paying property taxes on like a lower price, right? And so property taxes, you don't want to put what they're paying for property taxes when you fill out your sheet. You want to be putting what you're going to be paying based on the price that you're going to be paying. Now, we haven't gotten into the purchase price, but essentially, typically what I do is I double. Now, there's like a whole calculation that you could go in and really fill out. Like, you could figure out what the property taxes are going to be. But I typically find that if I just double them, then most of the time, now this is in smaller facilities and this is good secondary size facilities. When you get into primary market, it could be a whole different ball game, right? But essentially secondary and tertiary markets, you could do this. Taxes are $1,233. So what's $1,233? So that's $2,400. So I'm just gonna put $2,400 right here. Okay. CapEx is like if you need to do any repairs, fix it up, anything on the front end, that's where you put CapEx. Or if if you have some sort of initial clean out, if you're going to be putting any type of like, if you're going to paint it or put a fence up right in the beginning, right? How much money do you need, right? We're going to assume that this does not have any CapEx for this facility, right? It's just a small facility, ready to be bought, ready to go. Okay. The one thing that we don't have here is the total square footage. So we need to figure out what the total square footage is. And we do that on the unit mix sheet. Now, if you go to like ROI Muse and you get an online, like if you get an online deal analyzer, if you use, a different kind of deal analyzer, you're always going to have to fill out unit mix. Okay. You're always going to have to fill out unit mix. So, just get into the habit of filling this out. I mean, essentially, if you want to buy storage facilities, you have to start getting your brain to think in terms of square footage. Okay, so let's look at the square footage and see what it is. And another thing too, and the reason that we fill out our unit mix here is because we want to make sure that the square footage that they tell us matches up to what they say. Because a lot of times I'll just hear storage owners will say like, I got 5,000 square feet of storage, and the truth is like once you add up all of the storage units, it comes out to like 4,900 or 5,200 or something like this, and so, but you really want to have the true number. You want to have that true number. So the way we do it on our deal analyzer is we fill this out. So we have a 16 5x10s that are $45, right? So we just do a 5x10 and we do that is 50 square feet and we do 16 of those. And it spits out 800 square feet, and we just put $45 right into there. Okay. And let me see what else. Going back to my sheet here. We have 23 10x10s. And a 10x10 is 100 square feet, right? Yeah. Okay. And then 23. And then it was like $65. It's $65, I think, or $60. Okay, $60 right here. This row right here, it says current. This is like your as is price, right? This is like exactly what they're charging right now. And then finally, we have 9 20x10s that are $90. We have a 10x20. And that's 200 square feet. And we've got 9 of those. And they're, what did I say? $90? $90. Okay. All right. Now, so on this unit mix sheet, essentially, this is like current is like, this is how much we should be making, $29.10, right? If we were 100% full, we'd be making $29.10. Okay. And I remember on the sheet, he said that he basically took the vacancy away is what he did. Now you could also, if we actually knew, like this is where we come in and we say, what does he actually have full, right? He's 7% vacant. So which one of these is not full, right? And you could put like the actual current number here. But this is if he was full. So this is basically it. So 29.10. And then this is where potential is where we put competition. So competition is super, super important in like the storage world. You have to know what the competitors are charging so that you know whether or not you're, what you can bring that price up to. So he had that on the sheet as well too. He had $65, $85, and $125. All right. So this is what he said. Now, do I trust this number? No, I don't trust this number at all. All right. So this is what he's saying that we could be at, right? So we should be at 84 cents a square foot and we're at 59 cents a square foot. You see how I kind of brought that to here, 59 cents a square foot, and we should be at 84 cents. So we should be, and right now we're making 29.10, and he's saying, or she's saying, I don't know who the wholesaler is saying that we should be making $4,120. Okay. And also here, remember the reason we put all this in is because we needed to know what the square footage is. So the square footage is 4,900 square feet. Okay, so this unit mix sheet is a very, very important sheet to be looking at when you're looking at your Dillon and running Dill analysis. Okay, so let's go back to the info sheet. Let's change this number to 4,900. Okay, so now these numbers are looking good. The only thing we haven't changed is the market cap rate, and then we haven't put the price in here yet. Okay, the market cap rate. What could the cap rate be? Honestly, what could the cap rate be? I mean, honestly, the truth is that cap rates are all over the place right now. I mean, you see in tertiary markets, caps, things selling for 4, 5, and 6 caps, and you see secondary markets, things going for a 7 or an 8 cap, and it's just like it's a whole bunch of like BS. Cap rate, really, the truth is cap rate is just what you as the person buying is willing to buy it at, really. So what are you really willing to buy it at? And it just really depends on the location, really. It depends on a lot of factors. Cap rate depends on a lot of factors, but one of them is like where the location, the market is. So if it's a tertiary market, typically you're purchasing, you're buying at an 8 or 9 cap, or and if you're in a secondary market, it's like a 6 or 7 cap, and if you're in a primary market, you're like in a 4 or 5 cap right now. Okay. Now, is that going to cool? Yeah, that's going to cool down. But the truth is that the cap rate is just really kind of what you feel. We're going to play around with the numbers so I can show you what it is, but it really is just you coming up with the number based on whatever you think the cap rate is, what you feel that you'll pay for the deal. Okay, so that's really what I wanted to get at, is like people get so hung up on cap rate, but cap rate is all over the place right now. I mean, it's just all over the place. So the what you really should do, honestly, is instead of worrying about what the cap rate is you should put an offer in. That's really what you should do. Like, you should just put an offer in and then like see what they say. And they could just be like, the owner could be like, this is like the worst price ever. I would never take this offer, right? So then you know that you need to lower the cap rate, really. And then the question is, well, do I really want to pay that much money? And that's it. So don't get so hung up on the cap rate. A lot of people think that the cap rate is so important, but the truth of the matter is that what you pay, what you're willing to pay, what your gut is saying, about the deal is kind of where you should be at. Okay. It's kind of hard to explain, but I'll show you in the deal analyzer. Okay. Let's see now. This property, I can't even remember where this property is, honestly. I'm thinking that this property was in Texas, but I'm not 100% sure where it was, but it doesn't really matter where it was at. Okay. It was it's 48 units, and it's in a tertiary market. It's in a market that is like a smaller market. Okay. So remember that it could be a 7 cap. It could be an 8 cap. Now, it could be, you could try it. You could try it a whole different numbers. Now, the owner, the wholesaler, not the owner, but the wholesaler was trying to sell this property for $399,000. Okay. So we, at this point, like for this type of a deal, we know what the purchase price is. Okay. A lot of times you don't know, so you have to play around with the purchase price. But we know that this is what the wholesaler wanted. Okay. And we know that this property was in a tertiary market, and tertiary markets are typically going for 7 or 8 caps right now, but maybe a 9 cap. I mean, maybe a 6 cap, right? Depending on what we want to pay. Now, he wants $399,000. Okay, that's what the wholesaler wants. Okay. What he has under contract, we don't know, but we know that he wants $391,000. The question is this little section right here. Okay. It's the average rent per square foot on the after updates. And what I mean by that is, what is the competition charging? What is the competition charging, so that we know what we can be getting, right? Now on the unit mix tab, remember right here, this is what the wholesaler gave us. This is what the competition is charging, 84 cents a square foot, right? So let's go in here and let's just put, 84 cents. 84 cents a square foot. Okay. So now that we have pretty much everything filled out, now I'm going to get into competition in just a second, but we have everything on this tab in this input. This is like the input area, right? Filled out. These yellow little sections here, these are the expenses sections. All right. So like I said, you don't want to go off of what the owner has as their expenses. You want to go off what your expenses are. Okay. So here for our expenses, we have property maintenance, which is basically boots on the ground. So remember that the deal was, on the pro forma, he had on site, he had $2,000. We're guesstimating that this property probably takes about $6,000 to maintain with the boots on the ground person and all the repairs and everything. Now, that's based on our formula that we use internally, which is this formula equals 0.015 times C6, right? C6 is this purchase price. Okay, so you can't go let's just say that the owner's price was 150 grand or 180 grand or whatever it is, right? This number right here, this formula would be totally different. So for him to manage a $180,000 facility is a completely different number than us managing a $400,000 facility. Okay, so you just have to keep that in mind. And when you're running numbers, your expenses are more important than the owner's expenses. Okay. And also you see here we have the staffing. All right. And this is really like, our phone people, the phone person that answers the phone, does all the auctions and stuff like that, right? And so for a 48 unit, if you were only going to buy a 48 unit, and that was all that you had, then, you might be handling this yourself. So this number may not be, what you have, what your expenses are. Maybe cheaper if you're handling it yourself. Right? If you're the boots on the ground person, you're handling it all yourself, then this is going to be cheaper, right? Obviously, right? You should have some number in here. A lot of my students will come in, they'll just take the whole thing out. But the truth is that you've got to have money for property maintenance. You've got to have money for staff. This is paying yourself. So you want to make sure you have these. For us, we multiply 400 times 12 and then 50 times 52, right? So essentially it's $400 a week for the phone person that we pay. And then also that's the office person that manages everything for us. And then on top of that, $50 for like our evening calls or overnight calls and stuff that people answer for, because we always have somebody answering the phone 7 days a week, 24 hours a day, 7 days a week. All right. Because we don't want to miss any phone call at all. And then let's see, software is $3,600, which is $300 times 12. Okay, $300 times 12. So it's $300 a month. That's for Store Edge. They're typically around, like if you buy the website and the software, they're typically around $300 a month. Okay. So now let's see, marketing. Okay. And then finally, marketing is $633. And this is the formula that we use, which is C13, which is the number of units times 1.1 times 12. Okay. That's how we come up with our marketing formula. So, And then this number right here is the mortgage payment. We don't have this in yellow because it's calculated automatically. Now, obviously, we have this at 10%, but let's just say that we do. This is an income producing property. We can go and get a loan from a bank. Now, what is the loan from the bank going to be? Interest rates are going up, right? So let's just say interest rates are at 6% and it's for 240 months. Okay. So you can see the mortgage payment went from 40,000 to 24,000. So your mortgage payment is going to cost you around $24,000, and your expenses, including your expenses, it's over $40,000. All right. So in order for us personally, that's how much it's going to cost. Now for you, the expenses might be a little bit different here if you're going to be managing it yourself. But personally, we don't manage our facilities. We just, we delegate all that out is what we do. Okay. So now you have kind of an overview of everything all filled out here, what you need, right, in order to run deal analysis and to look at the deal. Okay. You've got all this in the current, you've got some after updates, you've got expenses here, you've got your mortgage set up. All right. Now the question is, what would you pay for this? Right? What would you pay for this? Now it's only making $34,920 a month, right? But once you increase the rates, and this is one of those facilities where you would just buy the facility and then increase the rates, like within the first quarter, notify everybody. Basically, you buy this facility. You notify everybody of the owner transfer, of the owner change. You are now the new property manager of this facility. And guess what? By the way, we're going to be increasing rates as well too. Okay. You've gone on too far, too long with cheap rates. And now we're going to increase the rates and we're going to bring it up to market value. Right. So that's basically what happens. And so within the first quarter, you increase the rates. You never ever want to take longer than the first quarter. In a facility like this, you never want to take longer than the first quarter to increase rates. You want to get in there, rip the Band-Aid. And the good thing is that when you start looking at the 84 cents a square foot for the competition, the good thing is that you really need to be keeping track of the competition. We have a whole internal system where we are keeping track of the competition. And in fact, in order for you to know whether or not it's a good deal, you have to look at every single competitor in the area. So that's why on this tab, on this sheet, we have a tab for competition. And this is where you go around and you find all the competition in the area. Right. And you mark them down. So you're going to have the name of the property, the phone number, website, email, the address of the property. And then sorry, oops, I scrolled over way too much here. Did they claim their Google business listing? Right. So that is that's a good thing. And to know how many miles away are they from your facility? Are they gated? Is there an office? Is there square feet? Do they take credit, ACH, check, or cash? Right. And then this is where you're putting all of the different sizes, right? So you'd have the 5 by 10. And then you would have 10 by 10. You'd say they have 10 by 10s and 10 by 20s and 10 by 15s and 10 by whatever it is. Okay. So you just put the number here. And what that does, so let's just say that they charge, let's say $50 for a 5 by 10. And then this one here charges $45, and this one here charges $65. All right. And then you also have, you have somebody that says charges 70, and then they charge 75, and then they charge 80. And then you can go to 10 by 20s, and you could say, okay, they charge 100, 110, and 120 or whatever. Okay. So then what you're doing is you're trying to find the average unit price, right? The average unit price. And then you're also trying to find the average per square feet, right? So if we take this number and and divide it by 3, most likely it's going to come up to, I mean, I don't know what the price is, but when you put the right numbers in, then you'll take this average per square foot and you could stick it right into here. So whatever it comes into, okay, this is that number. So you'll be looking at the unit mix, right, under potential to see what it comes here. All right. If you take the average per unit, if I take 53, 33, 75, and 110, and then I put them in here, right? Let's just say we do 53, 33. Was it 75 and 110 and 110, right? Whoops, I put the wrong thing. Sorry, 53, 33, 75, and 110. So this one comes out to 72 cents a square foot, right? So you'll put the competition in your sheet and you'll average it out. You'll look at the as is versus the potential. All right, the as is versus the competition. So this competition sheet is very, very vital to determining whether or not it's a good deal or not. So now you have your inputs in here, right? You also have your unit mix put in, and you have your competition put in, okay? And now you can really look at the valuation. You can look at each of the valuations. You can look at the current as is, right? As you can see, right, the debt service ratio is 0.53. Now, debt service ratio, essentially what that is just basically a number that the banks look at in order to determine if it's a good deal. They want to make sure that, you're not over leveraged. So they have this like formula. You can click on the formula and see what it is here too as well. And you could follow it through. But essentially what that means is that you want to be, if it's an income producing loan, if it's an income producing facility, you want to make sure that it's above 1.3. All right, 1.30 is basically what the banks are looking at. Most of the time, you'll find different banks with different numbers. Find out what your bank wants, actually. Just find out what your bank wants. If you have a bank that you're going to be using, and ask them, what's your debt service ratio? And they'll tell you it's 1.28 or 1.20 or 1.34 or whatever it is, so that you know. And then when you get all the information in and you can play around with the numbers, if this was the actual number, right, you could play around with it. If you have determined that the market cap rate is a 7 cap, if you say no, a 7 cap or a 6 cap, it's definitely a tertiary market, but I mean, it's going for like a 6 cap right now. And then you could say, okay, I know I would need to get a loan on this property. So, and what is the number that is going to allow me to get a loan right now? Now, in order to purchase, you see how this turned green. In order to purchase this property, I would not be able to get a bank loan on this deal, right? But if I came, let's see if I came down to 200,000. It's almost there, but not quite. We set the scale at 1.30. Yeah, so $195,000 is where you would need to be in order to get a bank loan on this property. Okay, and then once you rip the Band-Aid, you'll be in the green anyways. The property is going to be worth $437,000. Once you rip the Band-Aid, increase the rates to what the competition is, and then be more competitive, then you're going to have this property valued at $437,000. But you have to buy it at $195,000, right? So if we go back to the $399,000 purchase price, obviously it's only worth that. It's worth that if you actually increase the rates. And I see this all the time. people are basing their numbers on what the market could be. And you don't really want to do this. Now, it's okay to pay a little bit more for a facility, right? If you know that you're going to double the value on the back end. But on this facility, I mean, obviously this is not a good deal. 48 units, that's only making $34,000 is only really worth a little over 200 grand. I wouldn't pay 400 grand for a property that's worth 200 grand. Now I may pay 250 grand. I may come in and say, okay, I'll do 250 on this deal, right? And I mean, that's at a 6 cap. It's 250, So, so I wouldn't pay $399,000, and you should not pay $399,000. Nobody should be paying $399,000 for that deal. But the wholesaler essentially was just running the numbers off of this deal, off of this number, which is why it is very, very important to be looking at the competition and to be looking at, what you think you could be charging versus what you are charging right now. Now we only know this much. I mean, essentially we don't know if we can add on. We don't know anything else except for what was on that pro forma that I showed at the beginning of the session. So this is it, right? So my final offer is $250,000. I'll come out of pocket for the first 6 months or so to get it, up and running and current. I'll borrow money from a private lender. And then after a year of owning this thing, when I have 1 year of tax return, I'll refinance out and get a better loan. All right. I'll go get a loan from a bank. Okay. Now, or you could just buy it at $195,000. Right. And then that would be able to give you a green light in order to go to a bank and get a loan. All right. A bank at this price, a bank would definitely loan on this. Okay. So, so that is basically the deal analysis there. And then I just wanted to make sure that, you knew kind of how to look at the numbers, right? So this is the current numbers right now. This is based on it was based on what? $195,000, right? So the current valuation comes out to $261,000 with equity at $64,000 or $65,000, right? You have your gross potential rents at $37,548 minus your insurance and expenses and all this kind of stuff here, which makes your NOI, right, $15,717. Okay. Now, if you take a mortgage out, if you don't pay cash for it and you take a mortgage, then you're going to be netting $3,400. So essentially all that work for $3,400, right? Which is actually a no-go. We don't want to do that, right? So what we want to do is we want to make sure on the after updates that you can increase the price. I mean, increase the prices, right? So that's really the key, is like, you don't want to get something that and I've looked at properties where the owner just increased the rates. He's like, I just increased the rates, so then there's no room to grow at all. I mean, some people may want to buy that, but I don't want to buy a property just for cash flow. I want to buy a property for cash flow and appreciation, right? So you want to make sure that you keep that in mind. But so let's just look at the after updates here. And it says essentially, the valuation is $437,000. You're going to have $240,000 in equity, right? And your NOI after your income and expenses is going to be $26,000, and after your mortgage, it's $14,000. So you make a little bit over $1,000 a month on this deal. All right. So that is really kind of the gist on how to look at a deal. All right. So I'm going to answer a few questions, and then I'll do another one next time, right? I'll do another deal. So we'll practice looking at deals. So let's see, a couple of questions, and then I'm going to head over to the pitch. So if you do want to hang out with me at the pitch, just go to stacyrossetti.com/fund if you're interested in learning about the Self-Storage Fund of America. And then I'll be pitching that. I always pitch that right after this session, okay, to all my investors. Okay, good. How do you determine which markets are secondary and tertiary markets? Is there a rule of thumbnail or is it a good guide? Yeah, secondary and tertiary markets are basically based on population. My personal opinion, I would say population. So 25,000 or less maybe is a tertiary market. And then 25 to 100,000 would be like a secondary market, right? So for instance, I was talking to somebody today. I can't remember where they were, but they were saying some town in Tennessee that had 87,000 people. And that was like a perfect secondary market. Like, you know, we own a facility in like Valdosta. Valdosta has like 76,000 people in it. So, you know, those towns inside in your city that are like standalone towns that are anywhere from 25 to 100,000 people. Those are good secondary market, not suburbs. You don't want to be in the suburbs of metro areas. You definitely don't want to be there. It's just the price is going to be too high and people are just too much competition. So find like little tiny towns, 25,000 or less, or, you know, secondary markets, 25,000 to 100,000. Okay. Let me see. Is there a rule fund? Yeah. Okay, good. Let's see what else. How do you figure out what potential is if none of the competition has a particular unit size? Curious why the debt service ratio in your example and just how it's lower. Just now it was lower potential and current was. Okay, let me do one at a time. So, okay, how do you figure out what potential is if none of the competition has a particular unit size? Oh, so you need to, like essentially when you're doing competition, you want to compare apples to apples. All right. Now you don't want to compare like, you know, brand name to brand name or anything like this. Like, because the truth is like a competitor could be a bigger facility or it could be a smaller facility. And you really don't want to look at facilities that are charging way low rents because it's going to be just bringing, you know, it's going to bring your number down. What you want to do is you want to be looking at like a facility that would be considered apples to apples. So for instance, if like this one had 5x10s, 10x10s, and 10x20s, right? And these are all just drive up open storage unit like facilities. Okay, so you want to find ones that are like that, not just like, you know, rinky dinky small ones that are the same size. Same size is not important. What's important is that it's just the same type of unit, right? And then you don't want to use like tri-level, you know, double level or tri-level facilities if your facility is just like an all metal facility or something like this, right? So you just have to think in terms of like, what is the true competition? True competition is apples to apples, the same type of a facility and the same like units that they have. Okay, that's what you want to be comparing. Okay, a lot of students get hung up on that. Oh yeah, and so then I think because we were talking about, I didn't get into potential versus current, but potential is essentially taking it from, you know, a 25% to full, right, or 50% vacant to full, right? But sometimes it's already full, right? Sometimes it's at 7% or 6% vacancy. I typically like to run my numbers at 8% vacancy. This guy had 7. That's another thing, is that the wholesaler had 7% vacancy. Typically, you should be running your numbers at like 90 to 92% full. Okay, but he had 7%. We run our numbers at 8%, so that's why it was a little bit less than the current. Okay. We're looking at a facility that has a 10x35 and a 10x40 in addition to the common sizes, but none of the competition has those. Yeah. So then I don't even really use those numbers as competition. Like we try to figure out price per square foot based on what all the other units are doing. All right. So if you have, let's just say we have 5x10s, 10x10s, and 10x20s. And we came up with those three numbers. And then we had also a 10x35 or a 10x40. I would take the average price per square foot of that, and then I would multiply it by the one that we have, and then I would come up with that number and then try it. And then the thing is that you can always change the number, right? You can always change the number. Okay. Typically obviously smaller units are higher price per square foot than the bigger units, right? So you just kind of have to gauge it a little bit and see what you can do. Okay, good. All right. I'm going to hop off now and go to stacyrossetti.com/fund if you're interested in hearing the pitch for the fund. Again, you could check out Storage Nerds. Just go, you'll get on the wait list, which is storagenerds.com. And then go hit apply that you want to get in, and then it will take you directly to the wait list. And when the doors open, they'll open again in the fall. You'll get notified. I only open the doors for 6 days. I take calls for 6 days straight. And then after that, close the doors, and then that's it. Okay. All right. And then also don't forget that I have the Storage Nerds podcast as well, too. Okay. So all these sessions all become the podcast. So if you do ever miss anything, you can always go back and rewatch those as well, too. And the YouTube channel, which is Stacy Rossetti Teaches. Okay. And my course, I can't forget my course, Super Simple Self-Storage. If you need to learn, it's the course. All right. I will see you guys at the next session. I'm going to hop on to the other pitch. Okay. All right. Take care.
Thank you for joining us for this episode of Storage Nerds. Hope this informative conversation inspired you to go out there and jump into this highly profitable business venture that people rarely talk about. Get more tips on storage space investing at www.stacyrossetti.com. Don't forget to subscribe to the show and leave a rating. Together, let's build that thriving passive income one storage space at a time. Until next time.